CVS is having a very good morning with the stock up more than 10% in pre-trading hours. The announcement of earnings was well received by investors. A couple of highlights. Revenue continues to grow. CVS, the stock has been beaten down over the last 5 years. But if you look at their revenue, it continues to grow and grow. The company hired a new CEO recently and let go of their previous CEO. I think that was a good idea. A change in leadership is a good idea to get just a new, fresh perspective and a fresh start for the company overall. This stock historically has been a very valuable stock. If we look at the last 5 years, the stock was trading at $109 per share. It's currently at half of that value. I think the business continued to grow and get larger over the past 3-4 years as that stock price continues to go down. This company pays a nice dividend of 4.8%, and that is an attractive income stock. But the stock needs to continue to rise if it's going to reward shareholders appropriately. My feeling on CVS is that it's a valuable company. They continue to drive free cash flow. They're guiding for very good cash flow. And I'll do a valuation on the company based on their free cash flow forecast. Also take a look at their earnings per share and see where I think earnings per share is going to go for the company. Overall, I'll let you know if I'm going to continue to buy shares in CVS or if I'm just going to hold the shares that I already own or if I should sell my shares. Overall, I think CVS is in a rebuild mode, but it could really reward investors over the next couple of years. I think this stock could double because it has a lot of things going for it. But they'll have to execute really well and just continue to grow their business, improve their profitability, and continue to improve their free cash flows. Let me take a closer look and then run through a valuation of CVS. Do you want to become a better investor? Well, join our community. We have active long-term investors that communicate actively. We also get together on weekends and have a workshop as well as an investor call. I think there's a lot of good information, good experience, and ideas being shared. I encourage you to join. If you become an advanced investor, I will offer a one-on-one call included in your first month. You can get more details on the 3 levels of sponsorship that are available for this community in the video details. Thank you. CVS has a market cap of $69 billion, and the revenue is much higher at $361 billion. The net income is quite good. Their net income is more than 10% of their market cap. The PE is very low, 9.8, and then the forward PE is even lower at 8.5. Dividend rate is 4.81. The stock is up more than 10%, so that will come down a bit as the stock price goes up. Analysts agree that it's a discounted stock, discounted more than 33%. I'll take a closer look at what analysts are looking at with regard to earnings per share. The stock is down 21% for the past year, and I believe this stock is really setting up to really rebound and go up in value. There's a lot of good things going for it. One of the things I always look at is the company growing its top-line revenue? Top-line revenue tells me, are they continuing to sell more products effectively, sell to more customers effectively? Are current customers buying more products and services? In the case of CVS, they've never stopped growing. Even during the big drop in their stock price, they just continued to grow their top line. I believe that's an attribute showing strength in the business, that it is a desirable business because there's so much demand. And they're already a very, very big company. So all of that looks really good. The balance sheet, let's take a look at the balance sheet and see what debt to EBITDA looks like. When I look at total debt for the company, the net debt after you deduct cash from debt is $67 billion and EBITDA is $16 billion. So that is a problem area for the company when you have net debt of 67 and $16 billion of EBITDA. You would basically have to pay debt off in about a little over 4 years and a quarter or so. And that's higher than what I would like to see, which is 3 years. I'd like to see EBITDA have a value that where you can pay off debt in 3 years. So this is a red flag for CVS. The balance sheet is not ideal. They either have to increase EBITDA substantially or they need to lower debt, and they should have a plan around that. Looking at free cash flows, that's also an area where the company has had better years in the past, but they are getting better. Free cash flow historically had really great years. In 2019, producing $10 billion. In 2020, 13, 21, 15.7 billion. 22, 13.4. And it dropped to 10.3 in 2023. The trailing 12 months shows a really low figure. But if I use their year-to-date number and annualize it, I actually get a much higher number. And I'll show that to you in the valuation. But you can see that the business has had its problems. So the decrease in stock price isn't without merit, but it is improving. It is improving in the current quarters. And I believe it's going to get back to that $10 billion to $15 billion range, which would really reward investors because the stock price would really go up if that happens. 17 analysts cover CVS, and in general, they have a buy rating on the stock, and they believe the stock is discounted by 33%. The lowest valuation or price target that's provided is above their current stock price at $60. The average is 73.88 as a stock price, and there is an analyst that's very optimistic saying it's going to go up to $94. So in general, analysts do believe the stock is unappreciated and should go up in price. Looking at 2025, the earnings per share is going to grow nicely next year and continue to go up for subsequent years. This looks really good. The earnings per share looks phenomenal. Look at the PE, super low. I cannot imagine that the PE is going to get to 5.69 in a couple of years. So I think this stock's really set to potentially go up because the earnings per share are really going to look good. And today's a good example. They announced that their revenue really went up, and they also had to take a reserve expense because they're restructuring, and it was nearly $1.2 billion of a reserve on their income. Having said that, investors see that the business is healing and the stock's rallying in pre-market hours by 10%. So I think that if the news continues to come in that looks at the business is either close to fully repairing itself and now onto promising, periods, the stock is really going to move upward because these earnings per share look great. The PE looks super low. We're in an expensive stock market. When you look at a stock like this, it's like, holy smokes, they're really driving a lot of free cash, a lot of profits, and could really reward an investor that buys while the stock is low. I value companies by looking at the cash flows I expect the company is going to produce in the future. I also look at earnings per share. Let me show you what I think CVS is going to produce with cash flow, and then show you how I valued the company. So to first set up the forecast of cash flows I expect the company is going to produce, I started with year-to-date numbers, and then I annualized them. So year-to-date is the first 3 quarters. So I divide by 3 and then multiply times 4. And I get to $6.9 billion, and that'll be my starting point. I'll grow years 2, 3, and 4 by 15%. I believe they're going to hit that. They may exceed it. Then terminal value would grow at 4%. Those cash flows are represented here in the forecast, and I'm going to discount them by 9%, which is higher than other stocks that I've reviewed. If you look at like Apple, that's 8.5, Microsoft 7.5 for those 2 companies. So this is substantially higher because their balance sheet is risky. So I want a higher rate of return out of CVS. Having said that, I'm going to use 9% to discount those cash flows, and I get a net present value, an intrinsic value of $171 billion. I'll add cash and take away debt to get to equity value of $120 billion. Current market cap is $69 billion. So overall, there's about a 73% discount on the stock if I value the stock based on the future cash flows I expect the company is going to produce. Earnings per share is also a very good valuation. The earnings per share for 2025 is expected to be $7.29. I'm going to use a PE of 12. A company that is growing its revenues should get at least a 12, if not higher. So I'll use a 12. And I expect that they're going to grow 9% or better in the future. So when I value the company using earnings per share, I get a discounted stock of 72%. So combining the two, get to about a 72% blended value. When I look at the 2 techniques of valuing CVS, that's a very attractive discount for CVS. I think CVS is an attractive business, but it doesn't have monopoly like moats or competitive advantages. It is a very big company that has a strong network effect, and it is a vertically integrated business where it has retail operations in its pharmacies. It's a healthcare insurance payer. It also provides health services within its locations. So these things create a network effect, and I like that. So I'm putting a bit of the company in the green, the most desirable zone of my quadrants. But most of the business is in the gray. They have to operate very effectively. Now, this is a highly discounted stock. So the discount, I think, is worth the risk of this company. And I'm going to be buying more shares of CVS. I own about $15,000 of CVS, and I'd like to double that investment. Continue to review the company, look at the next earnings release, which will be for the full year 2024, and see that they're on the path of repairing this business. If that's the case, I really see this stock really working in 2025 and really providing a very strong appreciation curve for investors while paying that nice dividend. So that's my review of CVS. I'm a current stockholder of CVS, and I plan to buy more shares. And just a disclaimer, I'm not recommending you buy, hold, or sell CVS. I'm just sharing my experience as an individual investor. I hope you found it interesting. Thanks for watching, and good luck investing.